Good afternoon. Please first allow me to welcome the President of the Per Jacobsson Foundation, David Lipton, the Vice President and Secretary of the Per Jacobsson Foundation, Kate Langdon. By the way, I'm Guillermo Ortiz. I'm the Chairman of the Foundation. And I'm very pleased to welcome you to this lecture. Today I am honored to introduce our speaker, good friend, Lord Mervyn King, former Governor of the Bank of England, who will present us a lecture entitled "The World Turned Upside Down, Economic Policy in Turbulent Times," a very appropriate subject. Mervyn has had an extremely distinguished career, both as a policymaker and an academic. During his tenure as Governor of the Bank of England, he was also Chairman of the Monetary Policy Committee from 2003 to 2013. He introduced inflation targeting as a cornerstone of UK monetary policy and helped popularize this in the central banking community. I remember this well because back in those years, in 2002, 2003, we introduced also inflation targeting at Banco de Mexico, so we had very lively discussions on the subject. Prior to this, Mervyn King was the Deputy Governor from 1998 to 2003, Chief Economist and Executive Director from 91, and another Executive Director of the bank from 90 to 91. He was knighted GBE in 2011, made a life peer in 2013, and appointed by the Queen to be a Knight of the Garter in 2014. As I mentioned before, Mervyn also had a very distinguished career in academia. Currently, he is the Alan Greenspan Professor of Economics and Professor of Law at New York University and School Professor of Economics at the London School of Economics. He's a Fellow of the British Academy, an Honorary Fellow of King's and St. George Colleges in Cambridge, and holds many honorary degrees from universities in Europe and all over the place, so I will not name them because spend too much time. Mervyn studied at King's College, Cambridge, and Harvard as a Kennedy Scholar. He taught at Cambridge and Birmingham universities before serving as a visiting professor at both Harvard and MIT. He was also a professor of economics at the London School, where back in the 80s, where he founded the Financial Markets Group. In 2016, he published The End of Alchemy, which has been translated into several languages. And together with John Kay, Mervyn will release a book next year that I'm sure we're all eager to read it. So let me please welcome Mervyn to the podium so we can all listen to his lecture.
Guillermo, thank you. Ladies and gentlemen, good afternoon. Guillermo, Chairman, I think you were generous in your introduction, and you are the latest in an extremely distinguished line of Chairman of the Per Jacobsson Foundation. And I feel privileged today to be asked to give a lecture to honor the memory of a truly great international public servant. In the early years of the Bank for International Settlements, Per Jacobsson wrote its annual report, establishing a tradition of intellectual rigor and policy relevance that continues to the present. As managing director of the IMF, he personified its true role as a trusted advisor to governments. So tonight I want to offer a little advice of my own to those entrusted with economic policy in turbulent times. This year we celebrate the 75th anniversary of the founding of the Bretton Woods institutions. And this weekend, many of you are participating in their annual meetings. But it is no time to celebrate. A decade ago, we thought the banking crisis was over with the recapitalization of the largest global banks, and that the recovery, already visible in emerging economies, would soon spread to the industrialized world. But that recovery has proved frustratingly slow. And no sooner do we think we are on track to normalize than new obstacles appear. This week, the IMF revised down its estimate of world growth both this year and next. And every data release seems to bring more gloomy news. Before the financial crisis, the world economy grew at over 4% a year, almost 1 year in two. Since the immediate bounce back from the Great Recession of 2008-9, there hasn't been a single year in which the world economy has grown by more than 4%. And relative to GDP, global debt is higher today than in 2007. So if the problem before the crisis was too much borrowing and too much spending, then the problem today is too much borrowing and too little spending. The world economy is stuck in a low-growth trap. Following the Great Depression, there was a period of intellectual and political upheaval. First Keynesian and then rational expectations revolutions altered our views on economic policy. No one can doubt that we are once more living through a period of political turmoil. But there has been no comparable questioning of the basic ideas underpinning economic policy. That needs to change. The economic and political climate has rarely been so fraught. Ripples on the surface of our politics have become breaking waves as the winds of change have gained force. Trade disputes between the US and China, riots in Hong Kong, the fall from grace of several important emerging economies in Turkey, Argentina, and Brazil, not to mention the complete collapse of Venezuela, all remind us of the fragile nature of our world today. The European election results in May, and growing tensions between France and Germany over the future direction of the euro area should shake the complacency among European elites. And in addition, politicians in the United States have been turning inwards in an increasingly divisive political conflict, just as the Pax Americana, the mainstay of the post-war world, is slowly disappearing. Earlier this year, a new sculpture entitled "The World Turned Upside Down" was unveiled outside the London School of Economics. It's a large globe which has been inverted so that one can immediately see, as one cannot from the conventional Mercator's projection in 2 dimensions, the true size of Africa and Latin America and the vastness of the oceans. And this sculpture serves as a metaphor for my theme today, namely that the conventional way of looking at things has misled us in both the diagnosis of and the prescription for our current economic problems. Central banks and the economics profession more widely see their models as descriptions of the world. But this exaggerates the extent of our knowledge, especially in a world of radical uncertainty, where we simply don't know what might happen next. Models are neither right nor wrong, but helpful or unhelpful. In present circumstances, I'm going to argue that key features of standard models are unhelpful in 2 important areas of economic policy. Namely, first, getting the world economy out of its low growth trap, and second, preparing for the next financial crisis. Following the global financial crisis, we drew comfort from the fact that in the industrialized world, apart from Southern Europe, unemployment never reached the levels experienced during the Great Depression, when unemployment in the United States was over 14% for an entire decade, reaching a peak of 25%. By contrast, during the Great Recession, US unemployment peaked at 10% in 2009, before steadily falling back to 3.5%, the lowest rate for 50 years. And for this reason, we can claim that a repetition of the Great Depression was averted. But there is another way of looking at the economic performance of the past decade. Imagine that in 1930, an observer looked back at the growth of the US economy since the turn of the 20th century and noted that output per head had grown at an average rate of around 2% a year. They might then have projected forward GDP per head to 1950. Now, within a few years, that benchmark would have looked wholly unattainable, as in the early 1930s, output fell by 30%. But in fact, by 1951, GDP per head had recovered to the level that would have been projected 20 years earlier. Although significant resources had been lost in the interim, output was now back on its previous trend path. Now consider what has happened since 2008. Using the latest IMF WEO projection for the US through 2024, we might ask at what rate GDP per head in the US would have to grow from 2024 in order to regain its previous trend path by 2028, 20 years after the financial crisis. And the answer to that question is that GDP per head, not GDP, but GDP per head, would have to grow at 5.5% a year. Well, that's a pretty tall order. And without growth at that improbable rate, we will actually be worse off relative to pre-crisis expectations than was the case 20 years after the Great Depression. Following the Great Inflation, the Great Stability, and the Great Recession, we have entered the Great Stagnation. 6 years ago at the IMF, Larry Summers reintroduced the concept of secular stagnation to economic debate. It is surely now time to admit that we are experiencing it. In terms of the failure to meet reasonable expectations, it doesn't really matter whether the source of this secular stagnation stems from supply or demand. But if we are to escape the low growth trap, the diagnosis of the phenomenon is relevant. Conventional wisdom attributes the stagnation largely to supply factors, as the underlying growth rate of productivity appears to have fallen. But data can be interpreted only within a theory or a model. And it's surprising that there has been so much resistance to the hypothesis that not just the United States, but the industrialized world as a whole is suffering from demand-led secular stagnation. That resistance stems, I believe, from adherence to a particular model of how monetary policy operates. In this model, the economy grows at some exogenous rate on which is superimposed random shocks, headwinds or tailwinds, which are also exogenous and unobservable. Weakness of growth reflects either a fall in underlying growth potential or an unusually persistent negative shock. And the return to an equilibrium path is hindered by frictions of various kinds, and the role of monetary and fiscal policy is to accelerate that return to the equilibrium path. But this model, which has become ubiquitous in the analysis of stabilization policy, is, I believe, not helpful in today's circumstances. Why not? Because we entered and departed the global financial crisis with a distorted pattern of demand and hence output. National saving ratios were too low in some countries and too high in others. Now, normally we might expect changes in prices and interest and exchange rates to correct this disequilibrium. But this is where expectations enter the picture. The investment required to stimulate production in those sectors that could support sustainable growth is held back by extreme uncertainty about future prices. Producers can't meet future consumers in the marketplace, separated as they are by time and space. In the language of technical economic theory, a world of incomplete arrow-de-Breuer contingent future markets means that there is no mechanism for supply and demand to interact in order to make expectations of future prices and production consistent with steady growth. With extreme uncertainty, expectations are a dragging anchor on spending. And this is a story of demand-led secular stagnation driven by uncertainty and incomplete markets. And who can deny that uncertainty is at unusually high levels? Political turbulence, disputes over trade that could last for years, the disagreement within Europe over the basic structure of a monetary union, all of these have contributed to uncertainty that may not be resolved quickly. The new IMF index of trade uncertainty has risen very sharply over the past year after 20 years of broad stability at low levels. The index of global economic policy uncertainty, produced by Baker, Bloom and Davis, has reached record levels and is higher today than during the financial crisis. And the BlackRock geopolitical dashboard shows that policy risks are the highest for years and greater than at the peak of the Eurozone crisis. In such an environment, we would expect that a secular stagnation of investment spending would persist, and that is exactly what has been happening. Escaping from this low-growth trap is a different proposition than climbing out of a Keynesian downturn, and requires different remedies. In a Keynesian downturn, during a conventional business cycle, the aim is just to boost aggregate demand. Temporary monetary or fiscal stimulus restores demand to its trend path and can then be removed. We are not overly worried about which components of demand respond to the stimulus. But to escape permanently from a low growth trap involves a reallocation of resources from one component of demand to another, from one sector to another, and from one firm to another. There has been excess investment in some parts of the economy, the export sector in China and Germany, for example, commercial property in some other advanced economies, and insufficient investment in others, infrastructure investment in some Western countries. And to bring about the necessary shift of resources, both of capital and labour, will require a much broader set of policies than simply temporary monetary or fiscal stimulus. And where there is excess capacity, it will also imply writing down asset values on the balance sheets of both industrial and financial companies to more realistic levels. And that will require, given today's high debt levels, the recapitalization of some financial intermediaries in some countries. It is, I think, the failure to face up to the need for action on many policy fronts that has led to the demand stagnation of the past decade. And without action to deal with these structural weaknesses of the global economy, there is a risk of another financial crisis, emanating this time not from the US banking system, but from weak financial systems elsewhere. Much current debate is focused on whether monetary policy has sufficient room and sufficient power to counter a new economic downturn. Among many politicians, there is an ingrained belief that monetary activism is the answer to sluggish economic growth. And there are times, such as 2008 through, say, 2010, when activism is indeed appropriate. But far more urgent today is the question of which set of policies will support the reallocation of resources necessary to escape from today's low-growth trap. And the answer to that goes well beyond monetary and fiscal policies to include exchange rates, supply-side reforms, and measures to correct unsustainable national saving rates. Take Europe as one example. Further monetary easing and a weaker euro may be supportive of a recovery in the south, but it will further distort the structure of economies in the north. And until France and Germany can resolve their differences over structural reforms to the monetary union, monetary stimulus on an even larger scale is not just papering over the cracks, but widening those cracks. I'm tempted to say that the only advice one could give a new president of the European Central Bank is to stay in Washington. Certainly, the IMF has a potentially important role to encourage global cooperation, not formal coordination of policies, but a common move towards an escape from the low-growth trap through the adoption of country-specific policies to reallocate resources and joint agreements on ways of coping with debt reductions to forestall a financial crisis. And perhaps most important of all, the fund could help foster a private but challenging debate among policymakers about the merits of today's conventional wisdom. So let me turn now to how we might deal with another financial crisis and make a case for new thinking here too. The last financial crisis led to the Great Stagnation and was obviously costly in terms of lost output, but it was also expensive in financial terms. A recent IMF study found that the cost of interventions, including guarantees, to support financial institutions in 37 countries between 2007 and 2017 amounted to $3.5 trillion. Even for a central banker, that's quite a big number. It is hardly surprising, therefore, that such interventions have proved highly unpopular. Yet without them, the financial system and the wider economy would have collapsed. It's no accident that the recent book by Ben Bernanke, Tim Geithner, and Hank Paulson, the three musketeers responsible for saving the American banking system, is titled Firefighting. Confronted with a conflagration of extraordinary proportions, they hosed the financial fire with unprecedented injections of liquidity to prevent it spreading. And the use of overwhelming force became a guiding principle of crisis management. But if that principle means that in a crisis, all debt issued by the financial sector must be guaranteed by the government, that is, by the rest of us, then it's not enough to worry that in future the Fed or other central banks will be constrained in their ability to provide such guarantees. Instead, we must construct a political settlement under which we accept that in a crisis, liquidity is created to douse the fire, in return for some limit on the extent of maturity transformation that is created by the private sector. In essence, therefore, I'm arguing for a sort of tax on maturity transformation. Now, my concern today is not the mechanism of such a scheme. I've written about that in my book, The End of Alchemy, where I argue for a scheme of pre-positioned collateral of commercial banks with the central bank related to the maturity transformation of individual financial institutions. Rather, my concern today is the imperative of putting in place an ex ante framework for the provision of central bank liquidity to douse a fire. And I say this for two reasons. First, it's impossible to know when a small fire that should be allowed to burn and extinguish one or more institutions turns into a conflagration that threatens the entire system. That judgment was a problem during the crisis for all of us, even the three musketeers, who initially said no to firms that asked for help. They did not provide assistance to Countrywide. the US equivalent of the British bank Northern Rock. And they faced major problems in trying to save Lehman Brothers because lending against inadequate collateral makes no sense. If an agreed ex-ante framework with pre-positioned collateral had been in place, the problem would not have arisen. Second, in a crisis, it's just too late to create political legitimacy for the necessary emergency responses. Since the crisis, Congress has placed fetters on the ability of the Treasury and the Fed to fight the next crisis. The wheels of some of the fire engines have been dismantled. We should not be surprised that it has done so, because the actions taken during the crisis were not part of an armory agreed with Congress beforehand. But as former Fed and other officials have said, these restrictions on the Fed are undesirable. But they will be removed only in the context of a clear ex-ante framework that makes banks and other institutions that engage in maturity transformation part of an insurance scheme that is seen as fair. Insurance payouts are likely to be more acceptable than bailouts, and the political economy of bailing out banks would be much improved if we could show that banks had subscribed in good times to an insurance scheme which entitled them to borrow in bad times. Without such an agreed framework, in the next crisis, Hank Paulson's successor will once again be kneeling in front of Nancy Pelosi, I assume she will still be there, asking Congress to rescind the legislation that has restricted the Fed's powers. Now, as all financial firefighters discovered, only a solvent government, through its central bank, can create the liquidity demanded in a crisis. It follows that it's impossible to design a regime for liquidity regulation without it being properly integrated into the design of central bank liquidity provision. Radical uncertainty means that we cannot be confident which assets will prove to be liquid in some future crisis. Better to replace that regulation by an insurance scheme that ensures that all runnable liabilities are covered. Ultimately, the response to the crisis has been a combination, so far, of excessively detailed regulation on the one hand and a plea for greater freedom for firefighters on the other. Complex regulation imposes unnecessary costs of compliance and gives a false impression of the security of the banking system. And the absence of an agreed ex-ante framework for firefighting requires a commitment to use almost unlimited resources without political authority for the necessary actions. Now is the time for the Federal Reserve and other central banks to begin behind closed doors discussions with legislators to make the latter realize how vulnerable they will be in the event of a future crisis. Congress would be confronted with a choice between financial Armageddon and a suspension of some of the rules that were introduced after the last crisis to limit the ability of the Fed to lend. It's time for some new thinking about the lender of last resort function. Through the twin issues of current economic stagnation on the one hand and the search for a framework to deal with banking crises on the other, run two common themes. First, radical uncertainty means we should not place excessive reliance on models that assume knowledge we cannot possess, whether of the response of the economy to changes in economic policy or the numerical calibration of risk weights. As John Kay and I argue in our forthcoming book, Radical Uncertainty, the focus of policy design should be on robustness and resilience. Second, democratic legitimacy of policy actions derives from careful institutional design of ex-ante mechanisms. Central bank independence was granted by legislatures to achieve certain objectives, and the same principle should apply to policies for dealing with financial crises. our institutions matter. In 2005, at the annual Jackson Hole Symposium, I extended the traditional definition of price stability when I said, and I quote, "Economic policy stability is best thought of as an environment in which the decisions of households and firms are not materially affected by the need to ensure against future arbitrary or mischievous changes in government policy." Well, today the world has been turned upside down and is a turbulent place. A market economy cannot flourish if policymakers behave in ways that lead private sector agents to expect future economic policies to be subject to arbitrary or capricious changes. In turbulent times, expectations really matter. Radical uncertainty is weighing on investment and growth across the world, and there is simply no way of knowing from where the next financial crisis might come. Radical uncertainty pervades the outlook for world trade, the future structure of European monetary union, the rewriting of Britain's unwritten constitution, the rebalancing of the Chinese economy, economic policies across Latin America, the potential population explosion in Africa, and that is not even to mention the Middle East. To whichever parts of the world a firm exports, and from whichever part of the world a firm imports, there is just no market in which to lay off the risks that result from such uncertainties. The price signals that might encourage productive and sustainable investments are invisible when markets contingent on all these possible outcomes do not and could not exist. That is why a market economy, although by far the best means we have discovered for promoting prosperity, does not have self-stabilizing properties. And when the world economy is stuck, as I believe it is, in a low-growth trap, then even national policies may struggle to restore the profitability of private investment. Those were the conditions in which the Bretton Woods institutions were set up, and they are the conditions in which multilateral institutions are needed today to encourage cooperation among nations to find a way back to a path of sustainable growth that meets the aspirations of so many who today feel left out. That task will require intellectual imagination and ingenuity. The failure of conventional models to capture the reasons for weak growth of the world economy, and the failure to establish a proper ex-ante framework for the provision of central bank liquidity in a crisis, reflect an intellectual and political unwillingness to challenge the conventional wisdom. 75 years ago, the IMF was born out of a commitment to radical reforms to the international financial system. At Bretton Woods, half a century of global conflict was a pretty powerful incentive to contemplate something new. Is not a global financial crisis, followed by more than a decade of secular stagnation, sufficient to persuade economists and politicians to be equally radical? Another economic and financial crisis would be devastating to the legitimacy of a democratic market system. By sticking to the orthodoxy of monetary policy and pretending that we've made the banking system safe, we are sleepwalking towards that crisis. According to his biography, Per Jacobsson, and I quote, believed firmly that intelligent, practical people, if they are well and fully informed, will take the right decision, unquote. But there are times, and perhaps we are living through them, when it is more important to challenge the conventional wisdom. The World Turned Upside Down was the title of an English ballad published in 1646 as a protest against the attempt by Parliament to impose on the people an austere and unpopular version of Christmas. Successful elites, even parliaments, not only listen to popular concerns, they are open to new ways of thinking about problems. So let me leave you with these words of John Maynard Keynes from the preface to his general theory. The difficulty lies not in the new ideas, but in escaping from the old ones.
Okay. Well, thank you very much, Mervyn. This was certainly a thought-provoking lecture, and I'm sure that the audience has a number of observations, questions, so on. But let me open this part of the session by saying that you're actually touching on two fundamentally important subjects. One is the low growth trap, and how do we get out of this sort of demand-driven stagnation. And the other one, which is very much interrelated, is how to fight the next financial crisis, what are the tools needed to that. They're both obviously very much interconnected, although you did an excellent job in analytically separating them. Now, on the first part, the sort of conventional response to the notion of demand-driven secular stagnation is through fiscal policy, and proposals have been put forth, for example, for heavy investment in infrastructure and so on and so forth. But you make clear that the number of measures, the type of measures to escape from this low growth trap goes beyond monetary and fiscal policies. But this is all driven in a world of radical uncertainty. Now, suppose that we were able, you were able, or were able to agree on a set of policies that would actually help in the reallocation of resources that you mentioned, and to escape this. The elements that ignite radical uncertainty are separate from those. It's what's going on in the world, what's happening in Brexit, Europe, and so on and so forth. So if you can conceive of a set of policies which policymakers would agree, how do you deal with the fact that in this highly uncertain environment, these policies may not be effective?
So I think the first part of what I'm trying to do is to get policymakers to think about the fact that the degree of policy uncertainty that exists is very costly to every country.
Exactly.
And that there is a potential win-win outcome here, in which if economies, certainly the larger ones, work together, they may be able to reduce uncertainty by creating much greater confidence that if they reallocate resources in their economy, then other countries will be doing the same, and that we're both committed to get back to the path of growth of output on which we were before the crisis. And I think what I'm trying to get across is that the idea that somehow monetary policy is always the answer to a period of weak growth. There's no basis in any economic theory for that proposition. It holds only in sort of one commodity models that textbooks use to discuss monetary policy. Right. And these models are very helpful to think about certain issues, but they're not a description of the world. And I worry a lot that too many economists have confused the world for their model and their model for the world. And so what's been damaging, I think, to central banks is this view that central banks are the only game in town. And now we've got a new version of this, which is, now we can see from the evidence that central banks can't be the only game in town because we haven't got out of the low growth trap. So everything now is put on fiscal policy. And I think this is, again, a mistake. It's a much wider set of policies to achieve this reallocation of resources. That, I think, is the fundamental thing. When we were really young, all the courses we took in economics were quite sophisticated, and they had many commodities and many sectors in an economy. Now all the models seem to have just one sector. And that, I think, is missing something fundamental.
Right. Now, in the second part of your lecture, you go into the subject, very important subject, what to do with the next crisis. How do we... And the two things have happened, since the great financial crisis. One of them is that in several countries, particularly in the US, regulators and legislators have actually curtailed the powers of the central bank. You mentioned explicitly, the lender of last resort. And also regulation has also encroached in the ability of the Treasury and so on to respond in ways that were possible during the last financial crisis. The sort of conventional, let's say, thinking regarding what are the additional tools to fight the next crisis, given the fact that monetary policy has much less degrees of freedom. We're living in a world of negative interest rates, so on and so forth. So the additional monetary policy measures have a lot less power than in other circumstances. There should be some sort of combination of monetization of, let's say, fiscal resources, or even so-called helicopter money and so on. The central banks have to do something else. Now, that is blurring even more the distinction between monetary and fiscal policies, and mixing the sort of actors, the central bankers, which are unelected officials, with politicians and those who are in charge of actually affecting fiscal policy. This raises a number of questions. One of them has to do with the independence of central banks, and also the degree of difficulty of actually putting some facility in a central bank which is fiscally based to deal with this. So how do we square this problem?
So I would define the mandate of a central bank as, in very crude terms, being to create the amount of money that you need to create to maintain consistency with some long-run definition of price stability, but also to create the money that's needed to deal with a sudden sharp jump in the demand for money or liquidity in a crisis. And only a central bank can do that. But as you say, that potentially has fiscal implications. So you need to define very carefully, I think, ex ante, what the central bank can do and what it can't do. And I think the problem we've got is that since none of us can forecast where the next crisis will be or what form it will take, that we need the firefighters to have the discretion to create as much money as is needed to deal with the financial crisis. But it's got to be done within a framework that allows Congress or Parliament to feel that they have been involved in the design of the framework, knowing that ex post they can call the officials to give evidence, did explain why you took the actions you did and why they were necessary. But the framework has been agreed ex ante. And I think the way I would do it is to try to ensure that financial institutions engaged in maturity transformation have to pre-position enough collateral so that the central bank is essentially saying in advance, we will guarantee to extend liquidity to cover all your private runnable liabilities. That not only would, I think, be a framework that the parliaments could agree to, and therefore the firefighters would be free to implement the creation of money that they felt was needed in a crisis, but actually everyone knowing that would reduce the incentive for a run, which exists. Because at present, I remember saying to Alistair Darling in Britain in the darkest days, I said, when there was a run on Northern Rock, I said, you do understand, Alistair, that it's rational for people to run. He described that as unhelpful. But actually, this was a private comment to him. And the point was that unless he guaranteed the deposits of that bank, people would just run. And that's what we can design a framework, in my view. And the phrase lender of last resort has been bandied around too much when central banks were not willing to be clear about what they meant by it. And the old expression that everyone wrote about in the textbooks, lend freely against good collateral at a penalty rate, was hopeless in the crisis, because in the crisis it was a bit late to impose a penalty rate, didn't do any good at all, and the banks didn't have any good collateral.
Exactly.
So you've got to do something to break through that, I think. And I think it's worth making the effort to say to Nancy Pelosi and her fellow senators and people in Congress that you will want to be in a position where you feel you understand and have agreed to such a framework, because otherwise you're going to be in the position that you found yourself in 2008.
Right. So let me open the floor to questions. I think we have a couple of microphones.
Yep.
And so please, well, Ted, you, just for the record, state your name.
Yes. Ted Truman, Peterson Institute for International Economics. So you made a very cogent argument about central banks being where liquidity is. So my question, since we're here at the International Monetary Fund, is what role do you see the IMF playing in this new world, or presumably new world, that you'd like to create?
So I don't think the IMF should be in the position of creating money. Individual nations do that. But I think the IMF is a place where people can come together to receive reassurance from other countries that if they take certain actions, other countries will take actions that are consistent with the ones that they're taking. We can all be better off. And so I see the role of the IMF as being not a player that makes a lot of public statements or plays on the political stage, but behind the scenes creates the environment in which countries can come together for purely private discussions, and the IMF mediates it and says, look, don't you realize that if we all moved, policies will be country specific, but if we all move in the direction of doing things that may reduce uncertainty, we can be better off.
Wasn't that the idea behind this multilateral surveillance exercise that, before the crisis, remember the global imbalances and so on? It really never worked.
Well, but now we're in a position where, at that stage, one reason it didn't work was because countries had no incentive, because nothing had gone badly wrong at that point. We could see things weren't sustainable, but no one had any incentive to do much about it. Now, everyone's got a big incentive to do something about it because their domestic policies are not generating an adequate recovery. And I think therefore, there is a potentially very important role for the fund in this area. But it's not one which takes the form, I think, of saying, this is the policy that you should pursue, or that's the one that you should pursue publicly. But it's trying to bring countries together to see if there is common ground about how collectively we could get back to a better outcome. I'll give you an example. When I went to many G7 meetings, far too many. But anyway, there was a small window when the IMF played quite an important role in challenging the European Central Bank and the European Commission in saying, if you carry on as you're doing, you'll see a major structural challenge to the monetary union. What are you going to do about it? Now, if you do it in public, then you'll just get defensive responses. But there is a potential role for the IMF to do it in private, where people can have an open discussion without it being a blame game, but just there is a potential win-win outcome here.
Right. Caroline?
Thanks. Caroline Atkinson, Rock Creek Asset Management. Thanks, Mervyn. Terrific presentation. My question is about the first part and follow up from Guillermo, which is, why is there a difference in what you're recommending from the initial G20 response to the crisis? It seems to me that fiscal policy was tried initially, but never to a very large extent, and it was withdrawn quickly. So what is wrong with the shift towards fiscal policy now?
So I think the answer, I'm not against people discussing use of greater fiscal instruments, the precise nature of which would vary from one country to another. But I think the trouble was that in that initial G20 response, which was excellent in one respect, in that there was a real sense of wanting to work together, that only if we work together could we get out of the mess. But there was a view that it was just like another Keynesian downturn, but worse than normal. And so monetary and fiscal policy were enough. And I think that is the intellectual mistake. I think it goes much deeper than that, and it requires a reallocation of resources from one sector to another, one firm to another, and that is not something which traditional monetary and fiscal policy can do. That's not an argument for not using monetary and fiscal policy. It's saying you need to do a lot of other things as well. And it is unfortunate that when the G20 embarked on this process of cooperation, that in late 2008, 2009, I think,
2009, yeah.
It was very successful in many ways. But for some reason, countries then dropped out, as it were, and didn't feel they had a role to play. And the tragedy, I think, was that the G7 had basically said publicly that we want to hand on the baton to the G20 to, quote, manage the world economy. And the G20 didn't really live up to the hopes that the G7 had. And the G7 ended up by taking back the role of making key statements on the world economy and on exchange rates. And I think the G7 was genuinely disappointed by that.
Okay.
Hello, Bozi Darjalik from Lazard. So we've been advocating win-win solutions, new frameworks, and radical new thinking to address the very turbulent times. And I have to say it's difficult to reconcile with your stated position on literally the question of the day that, interestingly, you did not mention, being the former governor of the Bank of England, namely Brexit, where you called Theresa May's deal a betrayal, leading to Britain being a fiefdom of the EU, where you dismissed all evidence of your former institution, the Bank of England, saying that it's not obvious, it's a black box, ignoring also what employers, trade unions, and many others who have their lives on it have been saying about what you actually advocated, which is a no deal Brexit after 6 months of preparation. And so it's difficult to reconcile. And I have to say, I heard you stating, to my surprise, and I have to say, disappointment on UK national TV, that on top of that, the time-honored policy of Britain was to divide Europe, and it served it well, and it should continue in the future. So it's difficult to reconcile the very clearly stated position, which obviously has its merit, on the big known uncertainty of the day, with many of the recommendations that you seem to advocate in a more abstract manner. Thank you.
So with respect, I really don't see what Brexit has to do with the topics I was discussing. And I've always been surprised at how the rest of the world thinks that Brexit is so important. It's obviously important to the United Kingdom. I don't honestly believe that Brexit has any great significance even for the rest of Europe, let alone the rest of the world.
Okay.
I don't think the long-run economic consequences of the UK leaving the EU are particularly large. I do think Britain is in the middle of the worst political and constitutional crisis for arguably several hundred years. But that's a matter of domestic concern. And I think the tragedy in a way is that instead of a position in which people could say, well, this is my view and I understand why you take a different position. Maybe I put more weight on this part of the argument than you do. And respecting each other's positions, we've entered a situation in which, and this is not unknown in other countries now, there's a degree of political divisiveness which is deeply corrosive of a democratic system. And I think that is very sad and very unfortunate. And I think it ought to be possible for people to have a reasonable debate about whether Brexit makes sense or whether it doesn't. But now we're in a position where that tolerance of other points of view seems to have disappeared. And that, I think, has been deeply damaging to the performance of our own parliament.
Atul Singh, I'm the founder, CEO, and editor-in-chief of Fair Observer, a world newspaper with more than 2,300 writers from around the world. I will take you back to your lecture because I took copious notes diligently, as you might be pleased as a former academic. And let's talk about resource allocation that you talk about. And we could talk about it in the context of both the UK and the EU, which you referred to. In the UK in the past, in interviews you've given, you talked about manufacturing being more moral. You talked about banks placing profits before people. You even spoke at the TUC. And my question to you is simple. In the UK context, given the argument some people make that there's been excessive allocation of resources in real estate and finance and in the South, and places like Manchester or Liverpool, etc., have been, the Brexit areas have been thrown to the dogs. How do you do that resource allocation? Who does it? The market system, as you said, is imperfect, but fiscal policies really elected people. The question is who's going to bell the cat? Similarly, in the EU, the monetary stimulus that you talk, which is deepening chasms, of course, between the North and South. What do you do instead? And who does it? Who bells the cat and how?
So within countries, I think there is a growing recognition that policies need to be implemented to ensure that different parts of a country or an economy have equal opportunities for prosperity, and that when you have to reallocate resources between one part of the economy and the other, that we go out of our way to make sure that we help those people who lose out. I think one of the biggest mistakes that the economics profession made in the era of globalization was not to say globalization and the expansion of trade has the potential to make us all better off, but there will be losers. And this is what should be done to help the losers. We came round to the idea of helping the losers rather late in the day. I think that within most developed economies now, there is a view and an understanding that a wide range of measures has to be taken through the political framework, through Parliament, to help those people who lose out. The point I wanted to get across today was I think there's a similar issue about trying to ensure that the world economy, or at least the industrialized world, can escape from the low growth trap by working together. And I think I went through the whole period when I was a central bank governor. There was a perfectly understandable conventional wisdom that the best thing a central bank could do was to ensure that it met the inflation target and it looked after its own domestic economic interests. And I don't want to dissuade people of that view. What I want to do is to say there is another set of economic policies that we would do well to think about in the global context and not just the domestic one.
Thank you.
Thank you. There's a question here in the front. Microphone.
First, thank you for your lecture. I'm Ksenia Pavlovic-Makatir, by House correspondent of the Pavlovic Today. My question for you is the following. You have experience both in Europe and here in the United States. So what is your assessment of the American economy against the backdrop of the America First doctrine of the President Trump? And is the American economy really doing that great, like the president is saying, and especially in the context of this angry politics that he advocates from the Oval Office? Thank you.
It's never easy to get into the United States through the immigration queues and the questions, and I don't think I should endanger my ability to get in again by commenting on the elected president of a country which I've come to admire and appreciate greatly. I think I will leave it to my American friends to make decisions on all that.
Okay, we have a very quick one question here and then a couple of questions there, and we're done. Please.
My name is Pearl Matibi from Zimbabwe, but I do live here in this wonderful city of Washington. I really appreciate your lecture, very insightful. So Zimbabwe is an interesting case study. If you had Zimbabwe's central bank, what one key strength would you dig yourself and plow yourself out of turbulent times? And what key weakness would you point to that might turn yourself back right side up? Thank you.
Well, it's a very interesting question. And I've had many friends who came to Britain from Zimbabwe, often fleeing a difficult situation. It's an amazing country, arguably one of the best endowed countries, best educated countries in Africa. All I would say is I wouldn't want to make a judgment about what needs to happen in Zimbabwe without going there and spending time there. And I haven't done that, and I shouldn't therefore, draw any conclusion about what's needed. But I do think that one of the great achievements of the Bretton Woods institutions, whether the IMF or the World Bank, is that there is a place where countries like Zimbabwe can come and talk openly and honestly with people who they can trust have their interests at heart in giving advice. The advice may or may not be good, that's a different question. But it is done from the best of motives, and I think that's an invaluable institution to have, and I wish Zimbabwe every success.
Right. Yeah.
Sorry, Ricardo Leopoldo, Agência So sorry. As far as macroprudential measures, which kind of macroprudential measures the advanced economies could take in the next couple of years to try to avoid a little bit the risks and financial vulnerabilities that you have been facing now, and to prevent a kind of new crisis that happened in 2008 to not happen in about 5 or 10 years from now? Thank you.
So I'm personally not terribly enthusiastic about designing detailed regulation, whether it's conduct regulation or macroprudential measures, designed to prevent the last crisis happening again. That is the way in which most legislation, most regulators seem to go about it. And I think, because of my belief in the significance of radical uncertainty, I think we just don't know from where the next crisis will come. And so I don't think it makes sense to write, tens of thousands of pages of detailed regulations. As I said, I think the key principles should be robustness and resilience. And in my view, the most important ones for financial institutions are to make sure that they have issued enough equity capital, genuine equity capital, so they can absorb losses. And we found ourselves going into the crisis last time with a woeful lack of that. We've got a lot more now. Whether we got enough is a question that can be debated. In many ways, I can see benefits in going a bit further. But there's no answer. There's no right or wrong answer to that. It's inevitably a bit arbitrary. And I would like to see a scheme like my proposal for preposition collateral to ensure that the central bank stands ready to create liquidity on any scale when confronted with a crisis from wherever it comes that requires to meet that additional demand for money and credit. But for that to be acceptable to the rest of us, there has to be something like an agreed insurance arrangement of a much more comprehensive scale than we've got today. Those are the principles I would use to prepare for the next crisis, which we hope never comes, but which experience suggests probably will.
Thank you. The last two questions there, please.
Yes, I'm Robert Blome. I'm an economist and investment banker. I was a student of Robert Mundell, but my question doesn't involve his particular economics, but it's to address your concern about deposits, deposit insurance and so on, collateral. It's about fractional reserve banking, and there has been in the past a vibrant debate about that, whether to eliminate it and have 100% reserving. And in fact, there was recently a referendum in Switzerland where the central bank has now been given oversight, at least to monitor deposits and whatever, reflect that in policy. This issue is now arising in connection with central bank digital currency. And so the Chinese have an extreme suggestion in this regard, which is not 100% reserve. It's migrating all deposits into central bank deposits. So anybody on a cell phone would make a transaction and so on. Now, this raises questions about the surveillance state and so on, but putting those aside, is this issue of fractional reserve banking or not something that should be revisited, not just in the context of digital currencies, but your concerns about deposits?
Well, I think the crisis certainly meant that it was an appropriate time to revisit the issue and to answer it. My concern about getting rid of fractional reserve banking altogether, and also the application of just having central bank digital currencies, is that it doesn't solve the problem of who finances risky investment. And do you want it financed entirely by equities or mutual funds? We have benefited, I think, in the industrialized world, and I think all over the world, from the fact that it is possible to finance risky investments through issuing what seem to be safe short-term instruments through maturity transformation. And that's lowered the cost of what would otherwise be more expensive long-term investments. We've had more investment as a result. It does it at a cost that you can get bank runs, but my proposal is to, with this system of pre-positioned collateral, to bring that to an end. But it doesn't require getting rid of fractional reserve banking altogether. It's a question of taxing it somewhat, so you have a bit less of maturity transformation, but you don't eliminate it altogether. And there's a good book, which I read every now and then when I have to teach, called The End of Alchemy. And every time I read it, I'm quite convinced by the argument. So I would suggest you have a look.
I think George Soros had a book called The Alchemy of Finance. So.
Yeah. Thank you. Very last question there.
Thank you, Governor King. Your recommendation of having a pre-position collateral so that the central bank can lend easily during crisis. If I'm not mistaken, it means that banks should maintain sufficient amount of high-quality assets, probably with the central bank, so that the central bank has the comfort that they can lend against good quality assets. But isn't that what the banks have done in the past 10 years by maintaining trillions of dollars and trillions of euro as excess reserve with their central banks?
So it's certainly true, and this is discussed in the chapter on all this, that one of the ways in which commercial banks can meet the requirement that they have pre-positioned collateral is indeed to have higher reserves with the central bank. And that's one reason, I think, why central banks ought to be a little cautious about running down central bank, commercial bank reserves by withdrawing QE too quickly. And I'd like, we don't have to keep them at that level, but the great virtue of QE, which was not why it was done, but it was a spin-off effect with a real value, was that it made the commercial banking system a lot more liquid than it had been for a very, very long time.
Okay, well, let me bring this meeting to an end, and please join me in thanking Mervyn King for this wonderful speech.
But again, I think this